How to pick stocks. It's something that we've all pretended to be able to do at some point in our lives. Of course, right before the market incinerated our portfolios and the unearned confidence we once had goes with it. But there must be a path we can take, a set of principles that we can follow. And I think I've found the guy. His name is Mohnish Pabrai. He manages over $700 million and has grown his clients' wealth by closely following Warren Buffett and Charlie Munger, the two leaders of the value investing cult that is Berkshire Hathaway. And he gave us the secret sauce in an interview he did yesterday that I definitely hosted and didn't steal from Ironhold Capital. And from this interview, I learned how to pick stocks that actually go up over time. And it all starts, according to Mohnish, with the selection process.
If I can find 2 investments in a year that we can make, I think we're doing well. I think through the first 8 months of 2022, I found 1 investment. And just recently, a second one.
The first lesson here is you have to be patient. You can't be expecting to be able to find great investment ideas all the time. And if you've just been starting to learn about investing, don't expect that this week or next week that all of a sudden you're going to find a gem that's going to grow your wealth into the millions over the next few years. It's pretty unlikely. And even for the best investors in the world, it's a slow, grindy process. And as he said, it's just a couple of investment ideas per year, if that. And one very kind of extreme example of this is Nick Sleep, who is another guy who follows these Warren Buffett, Charlie Munger core value investing principles. He ran a fund in the early 2000s, but essentially, in the end, his portfolio was made up of just 3 stocks: Berkshire Hathaway, Costco, and Amazon, and he held those 3 stocks for the better part of 2 decades and generated significant returns on the back of 3 investments and then doing absolutely nothing in between. So what does this stock selection process actually look like? Well, Mohnish gives us 4 ways that he goes about finding and generating new ideas.
With that large a universe, sifting through things and being, just asking basic questions like, is this within circle of competence? What is this worth? And that sort of thing. It will get rid of a lot of companies.
First of all, most stocks are going to be an immediate no simply by the fact that you won't have the ability to develop a deep understanding of that company. And for me, this is a lot of different areas. Biopharmacy is something that Mohnish talks about as one of his, and I agree it's the same as me. I find other types of businesses really complex, like financial businesses or payments businesses, and I tend to gravitate towards businesses with relatively less moving parts, and especially businesses that I can understand from a consumer behavior perspective as someone who maybe uses those products or just has a passion for that particular area. So the tip here is to start by focusing on areas that you've worked in so that you have some kind of inside industry understanding of, or areas where you're a consumer of the product or an area that you are passionate about. And that's ultimately really important because it takes a lot of research over a lot of years in order to understand these businesses very, very well. And in order to do that, that means that you're going to be spending a lot of time reading about the mechanics of these businesses. And if you don't enjoy learning about those businesses, you're just going to give up and not learn enough and ultimately make bad investment decisions.
You limit yourself to only buying businesses that have a write-up on Value Investors Club. If you use the Value Investors Club as a starting point to doing research, it trims down the data set quite a bit. And the write-ups are pretty good. So if you just went through and just read the write-ups and then just left with the ones that you think are businesses you understand or thesis that you agree with, then that becomes a basis to do more work and see if any of those can jive with you. So that can be a good source. Data Roma, which gives the 13F filings of a bunch of great investors, that can be another great source. Barron's could be a source. There's a number of sources you could use.
And then Mohnish goes on to talk about other resources. Sorry, just one sec. Hey, Mohnish. Oh, yeah. You left one resource off the list? Seeking Alpha. Yeah, okay. And you want me to tell them your affiliate link? I mean, okay, you're the boss. And while Mohnish didn't talk about this resource, one other resource that I like to use is Seeking Alpha. Seeking Alpha is a fantastic resource for farming ideas and following news about public companies. Among other things, I like to use Seeking Alpha to follow news and look out for companies in areas I understand that are potentially going through some kind of short-term problem or mismanagement that may put the stock price down, but give me an opportunity to own a piece of a great company at a great price. Check out Seeking Alpha for free and also get 58% off a premium account if you sign up at Heyman jamieschotto.com/seeking alpha. The link is also in the description below. One of the most important elements of analyzing companies is to make sure that the businesses we invest in have a deep economic moat, which is essentially some kind of unique competitive advantage, something special about the business that protects it from competition over time. So how do we identify economic moats in companies?
Business that is within your circle of competence, the moat will be very apparent to you when you just think about the business.
Monish is saying here that if you truly understand the industry, you should have a good grasp on what differentiates the numerous mediocre businesses from the few great ones. Essentially, the more that you read annual reports for companies and their competition, learn about founders and the mechanics of businesses, the better you will be at identifying these deep advantages. The nature of some businesses mean that as they scale, they benefit from cost efficiencies. The cost per unit goes down. And for those kinds of businesses, the leader, if they're far ahead of the competition in terms of how many units they're producing and the scale that they're at, will have an easy time at charging less for their products than competition while remaining more profitable than those businesses, essentially because of their lower costs. For other businesses, it might be a brand that they've built and developed over many decades of marketing and generating and producing a great product. And ultimately, that might allow the company to price their products at a premium above competition, again, allowing them to be more profitable and generate higher returns on capital. And that's only two examples, but there's already a theme with these economic moats, and it's essentially that there's some key numbers in the business, some data that can show us that a business has a distinct advantage.
It would get ratified when you look at the numbers. So generally speaking, a great business is going to be generating high returns on equity without much use of leverage over a long period of time.
A good example of this is the Starbucks brand and their efficiency in new store openings.
Even before I look at the numbers for Starbucks, I know it's a great business. I mean, I know for a fact that when they open a store in the US, they get all their money back in 2 years. That is a business that is generating something like 36% unlevered return on equity.
But ultimately, Monish actually thinks that the identification of economic moats is a relatively easy part in the scheme of the overall process. And there's actually something else that's a lot more difficult.
Knowing what is a great business is not a difficult exercise. Then the next piece, which is it a great investment? That's a much more difficult question.
And I definitely agree with Monish here. I think most people can look around at the businesses and the products and services that they use and relatively easily identify the businesses that have developed a deep brand moat, for example, or have some kind of scale efficiency. What's difficult is figuring out what these companies are worth, and that's the process of intrinsic valuation. So what is intrinsic valuation?
The definition of intrinsic value is relatively simple. Calculating it in most cases is far from elementary. So actually, it was John Burr Williams who came up with the concept of intrinsic value and defined it several decades ago, and maybe about 100 years ago. And he said that it was the sum of all the cash you could pull out of an enterprise between now and Judgment Day, and then you would discount it back to present value by some reasonable interest rate.
The mathematical representation of this is a present value of discounted cash flows. And if you want, my free stock analysis spreadsheet, which you can download via the link in the description below, includes a DCF, discounted cash flow calculator, that does the maths for you so that you can focus on the elements that make up the formula, which is essentially a process of figuring out what money can be pulled out of the business today, so how much free cash flow or cash flow for owners is being produced by the business today, how that's likely to look in the future, right? For some businesses, they're going to be relatively stable. What they're producing today is what they're going to be producing in the future, and how much you can pull out on a year-by-year basis will stay pretty stable over time. But for other businesses, they'll have the opportunity to relatively easily reinvest money and grow their profits, grow their cash flows over time. Funnily enough, Monish actually doesn't agree that you should use spreadsheets of any sort.
That if you need Excel to figure out what the intrinsic value is, there is a problem. If you cannot do it in your head, there's a problem.
And even though I do have a free spreadsheet resource that I personally use to analyze companies as well, I actually kind of half agree with this. I think that the investment idea and thesis and in your projection of the business going forward should be plain and simple enough and baked in the data clearly enough that you can go through the process in your head. What you definitely want to avoid is using a spreadsheet and getting to a precisely wrong answer, thinking that you can specifically calculate what intrinsic value is, which is not something that you can do. But in my view, knowing that, you should use spreadsheets to confirm your mathematics is correct. I don't think that you should handicap yourself by not using a calculator. You must do the maths in your head. Sure, you should be able to reach conclusions in your head, and that's how you can go through and analyze a lot of companies very quickly, but that doesn't mean I'm not using a calculator just for the sake of it. That's just handicapping myself, tying one arm behind my back for no reason. Ultimately, calculating intrinsic value is very difficult, but Monish gives us a few hacks that we can use to make it easier.
The first hack is that we don't need to know the intrinsic value of everything, and we should not even aspire to that. Most stocks would fall outside the circle of competence of a given individual investor or an institution. So if something is not within circle of competence, there's no need to try to figure out what it's worth because we're not going there.
This goes back to the first tip: only invest in things that you deeply understand and just ignore the valuation of things that you don't understand. It's the simplest way to go about it. Just because I don't invest in a company and it goes up heaps doesn't mean I missed out on an opportunity. If I can't value that company, if I don't understand how it works, then of course I don't care if the stock went up. Me not investing in a company isn't me saying it should go to zero. It's just me saying I don't understand enough. There's not enough clarity here for me to feel confident putting my money into that business.
We don't necessarily need to figure out intrinsic value. What we need to figure out is it's above X, where X would give us acceptable return.
This is really, really important. I think it's actually the most important thing to understand when doing intrinsic valuation. You're not trying to come to a precise calculation of exactly what the business is worth. What you're trying to do is come up with a projection that is highly likely to ring true. And that way, when you use that projection in your modeling, in your projection, in your calculation of how the business will do for you over time, and you buy the business based on those projections at an appropriate price, then you're very likely to do well. I know that some of these lessons seem simplistic, but it's understanding the core well that is super, super critical. Investing in businesses that you deeply understand, staying within an area that you understand. Only investing in businesses that have something protecting the business over time, some kind of deep advantage, and make sure you know what the business is worth, or at least when you're buying the stock, you need to be making projections that are highly likely to occur. Only then could you be confident that when you buy a stock, it's going to deliver a significant return for you over time.